Good morning, everyone. Let's start with the next topic, right? And today's topic that we're going to start is capital structure, right? Remember the last topic that we have discussed, leverages. Hello? You all people were there in that recording also, right? The last question that we have discussed some time back. What we learned over there, leverages question number 9, what we learned over there. We learned that by altering capital structure, what can happen? EPS can increase, right? So as a finance manager, what we are going to learn in this capital structure topic, as a finance manager, what is my ultimate aim? My ultimate aim is to improve the wealth of the equity shareholders, because who are the true owners of the business? Equity shareholders. Who are the true owners of the business? It's equity shareholders. So how to improve the wealth? Sorry, how to improve the wealth of the equity shareholders? Means company should give them one car, company should give them one bungalow, if possible two bungalows. See, what did they invest in your business? They invested in the form of equity share capital. Listen to this is very important. They invested in the form of equity share capital. Raise the value of that. That is more than enough. You just raise the value of equity shares. Let them buy car and bungalow by selling that. Correct now? Why people invest in equity share market? For getting that capital appreciation. Right? See, people who have invested long ago in some good shares and are sitting on them. Okay, not means I mean to say not really, but means they're just peacefully sitting. Right? They have made good returns by investing in good shares. Correct? Okay. When you have spare time, no, you go through YouTube and search for MRF tires interview. Okay, there's one interview on the net. You know what? There's all news channels, market news channels. They keep some sessions like where an investor can give a call and ask his doubt, right? Like that, there was one doubt by one fellow. He had called. He said, my grandfather had purchased MRF tire shares at face value, 20,000 shares. Okay. Later on, grandfather did not bother to see. It was bought at face value when the company had just started. Now, grandfather is no more. Grandfather did not convert it into demat. So there are physical shares. So what do I do? I have a physical share. He said, fine, you get it transferred. And then he told him, see, these interviewers are professional ones, so they don't react. But the surprise element was visible on his face. The value of those shares that time back, it was some instance 4 or 5 years back. That time the value of the shares was 154 crores. The grandpa made the life of his grandson. So, should a company buy house and car and bungalow for you? No, not needed. Just increase the value of what? Market price of the share. And the analyst told him it is all good, even though you are having this much huge value, it's all good still to hold those shares. And the shares is still going to improve. And it's up to you. Sell and make house and bungalow and car, live a luxurious life, or stay invested and let the value increase. That is your decision. But if you come to me as a shareholder, I'm the company and you ask me, what have you done for me? I will tell you, see, your share was 10 rupees. Now your share in the market is 90,000 rupees. Compounding wonders, yes. Getting it? So understand this, guys. As a finance manager, what's my job? My job is to maximize the wealth of my shareholders. How that can happen? That can simply happen. I have to raise the market price of the share. Everything remaining constant. market price will automatically increase if you increase the earning per share. Okay. So how I will raise the capital? Well, make sure that the EPS is maximum. Right? I just now told you in the earlier topic that how I can increase EPS. There are two ways. One, start increasing the sales. That is a simple thing to do, sir. You increase the sales, the profits available for equity shareholders will increase, sir. So EPS will increase, sir. That is one option. But what is the second option? You arrange the most efficient capital structure. Remember question number 9 of leverages topic. You come into the new recording, that doesn't mean it had happened again last year. It happened 5 minutes back. Friends, don't make face. Oh, when did we do it? We just did it. What did we notice in that? That the preferential holders are making negative earnings. If company means this is not the efficient capital structure, 10 of equity and 2 of preference and 8 of debentures. That is not the best. 6 of debentures. That's not the best capital structure. What should company do? Company should remove preference shares and use either equity or debentures as per the management's plan. So tell me, without doing anything, EBIT remaining at the same level, tell me, will EPS increase or not increase? They remove preference shares. So Shri Prasanna is continuously saying no to this. I don't know why. Hello? Will it increase or will not increase? I just remove preference shares from the pocket and replace it either by what? Debentures or by equity. Tell me, will earning per share increase or not increase? Will it increase? It will increase, guys. Without doing anything also it will increase. Even if the sales remain same. Are you clear to this? Right? And that is the main crux of the matter of the next topic. That is what we are discussing now. That is capital structure. Okay, friends. So let's go through it. Okay, so let's come to capital structure. Okay, so let us start understanding this capital structure. Okay, the dictionary meaning of the word capital is what? Money required to start or run the business, and the structure means what? Arrangement. Guys, before we read this, by virtue of the previous question, we already know that arrange the capital in such a manner that what? EPS is what? Maximum. EPS is what? Maximum. Are you clear? Yeah? Okay. Fine. So, how to arrange the money required to start or run the business? See, very, 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 very important discussion now. Very important discussion. Okay. How we will arrange this money? Okay. We should arrange capital or money in such a manner that wealth of the shareholder increases. I asked you these questions, you remember? That what do you mean by increasing? What do you mean by increasing the wealth of the shareholder? Huh? We need to give them some bungalows and cars in gift? No. Ensure that the market price increases of the share. Correct? After that, from that, if they want to buy a bungalow, let them buy a bungalow. Want to buy a car, let them buy a car. Want to buy a motorcycle, buy them a motorcycle. Want to buy a cycle, buy a cycle. Want to buy a gold, silver, platinum, nickel, aluminium, iron, buy everything. Our task is to increase what? The market price of the share. Am I clear to everyone? Okay. So, so we should arrange the capital or money in such a manner that the wealth of the shareholder increase. And very important, wealth of the shareholders increase when what? MPS increases. So my target is to raise the MPS. Remember, guys, other things being constant, MPS will increase when what? When EPS will increase, correct? So see, MPS will increase when what will increase? EPS will increase. So my task is to enhance wealth, obviously enhance MPS, obviously enhance what? EPS. Simple. So that's why what we are saying, see, in other words, raise money in such a manner which helps to maximize the EPS. Raise money means what? Raise money means select that capital structure. Okay, so you can, when you want to read it again, read it by replacing these words. Instead of using the words raise money, say what? Select the capital structure in such a manner which helps us to maximize EPS. Could you read that second time by replacing the words? Hello? Did you understand what I'm saying? Guys have suddenly become unresponsive, non-responsive. Did you understand that part? That raise money means what? You should not, you should understand this. Raise money means what? Select that capital structure by which, yes, thanks, by which what happens? You maximize the EPS. Okay, sir, fine, understood. What to do in this topic? First part, how to select financial plan. Hello, financial plan means only capital structure. Tell me the answer to this. How to select capital structure? Just now read in the earlier line. What? Select that capital structure where what is maximum? EPS. EPS. Chalo, at least some people have awakened. Enhance wealth, EPS, MPS, MITRA. So select that financial plan or that capital structure where EPS is maximum. So you learned the first part. Okay. Now, important is to then the second part, that is calculation of what? Indifference level and the calculation of financial break-even level or break-even point. Okay, friends. So this is something new that you're going to learn over there. Hello? You're doing markings on your notes? Sure now. Okay. Thank you. Done, people? Okay, fine. So see the first part, it is very simple. Which, yes, Bharat, I'm reading your messages. Which plan to select, which capital structure to select? Very simple. The first part is very simple. Means that is a one-liner where EPS is maximum, right? But to reach there, you have to learn these two new concepts: indifference level and financial break-even point. Okay, these two new concepts you have to learn. Do I need to explain you the meaning of indifference? Tell me, friends, do I need to explain you the meaning of indifference? Right now also you can see. I ask, see, I ask so many questions, knowing that you all are on mute. Still, many of you respond, many of you reply. Correct? And knowing that I'm not listening to in individual sense, in a real sense. Some people are like this throughout. I'm asking from you, did you understand? Huh? Did you understand? No response. Indifferent behavior. Not affected. Turn your videos on. Talk to me. Eh, indifferent. Right? Correct? You understand? So, what is going to be indifference point? So now let's understand indifference point. Okay. Have you written anything in your notebook till now? No, sir. You have not written anything in your notebook. Right? Now it's the time to start. Okay. Open your notebook. Give the topic's name, capital structure. So let's start with that. Please, guys, write this meaning, objective, and scope. Refer JKC notes. Once you give the topics heading over here, capital structure. You remember in one more topic we have done like this. In working capital also, I think I made you write like this. See, this is our study plan. This is our study plan, right? Okay, that whenever you open your notebook, yeah, provided you revise, provided, yes. Okay. Yeah, in the ratios also we have written that, correct? Yes. Whenever you revise, you open your notebook for revision first. And then you will not get this. Now, suppose I start with the next concept. You will not get the link of revising. See, what is the very first argument put forth by student, Student is, sir, it is there in the textbook, no, sir. So you read from there. No, it's not about that. It's about the map of revision. Right? Today, what is the obvious thing, guys? After 3-4 months, we forget. We open the notebook and we see the question getting solved. And we, oh my God, now how do I solve this? So to get into the flow of the topic, what is required, you tell me. You first need to open your JKC notes and read meaning, scope, objective over there. That brings a flow. That brings a flow. So please do that. Please do that. Okay? Just writing one line. For these things, refer JKC notes is not a big pain. In fact, it's a systematic planning. Okay, so now the next thing that we are going to discuss, okay, is about what? Obviously, I told two concepts we have to learn. Indifference level we have to learn and financial break-even point we have to learn. Very, very important. Indifference level or indifference point. What is that? It is that level of EBIT at which what happens? EPS of both the plans is same. That is at indifference point what happens, guys? EPS of plan 1 is equal to EPS of plan 2. So why this is called as an indifference point? Suppose you create two capital structure, okay, equity, debt, combination of something, and the second capital structure say equity, preference. You place it in front of equity shareholder and you ask him, sir, which plan you would like to select? He will have only one answer. Select that plan where EPS is maximum. Did you understand this? Are you listening to me carefully? Yeah, we are developing the logic of the topic, guys. So listen to this very carefully. Okay, that you get to create two capital structures. One is having like equity, debt. The other one is having something like equity, preference, etc., etc. And you place them in front of your equity shareholders for approval. That okay, which plan we should go for, sir? Equity shareholder will have a simple answer. Go for that plan where my EPS is maximum. I want my wealth maximization. Right? So what will be the indifference point with reference to this? Very simple. You place two plans, both the plans have same EPS. Suppose both the plans have what? Same EPS. Then what will be the reply of equity shareholder? They would say go for any plan because both the plans are giving me same EPS, so I'm not affected. I'm not affected. Did you understand this? Right? See, go step by step. Don't immediately come out of my screen. So, but then how it will help you to select that we will discuss later. First, you understand what is indifference point. Indifference point is that level of EBIT at which what? Sabari, hi beta. Good morning. You listening? Okay. So, what is indifference point? It is that level of EBIT at which what happens? EPS of both the plans is going to be same. Did you understand that? Okay, good. Indifference curve is a different thing there. Indifference curve is about what? It's about the various points of consumption at which what happens. Utility is same. Correct, na? So their combination of you first learn diminishing marginal utility law taught by Alfred Marshall, right? Na? Where you consume only one commodity and your marginality goes on elimination. So what is indifference curve? Indifference curve is a mix of two commodities, combination of two commodities, commodity A and B, in such a manner that any combination gives you same utility. Only what you can understand from there is just a meaning of the word indifference, that any given combination of commodity A and B give you same utility. So don't try to apply that logic over here. Okay. Here we will have more than two capitals possibly. You may have equity also, preference also, debentures also. You never know. Okay, so we cannot be in a two commodity set. So let's not try to equate that with this. But what is there? The fact remains that EPS of both the plans, both the capital structure would be same. So it will be indifferent. So yes, I would like you to draw the meaning of the word indifference from there. That's it. Okay. So not you will not have any choice between the combinations. So see, the equity shareholder will select that plan where EPS is what? Higher. But if EPS of both the plans is same, then he will not have any choice between the two plans. That's what he will be indifferent. Okay. Now, see, a basic income statement, and yes, a doubt that can always crop up in your mind. Why start from EBIT and not from sales? Okay. We see the wordings. The wordings of the indifference point are what? It is that level of EBIT at which what? EPS of both the plans is same. Guys, why not start from sales? You tell me. Above EBIT, the income statement I've written on the left hand side, right? Above EBIT, what is left out? Sales, variable cost, contribution, operating fixed cost. Correct? So you know what is a simple answer for this? The simple answer for this is selection or capital structure does not affect sales, variable cost, contribution, and fixed operating cost. Get it? Whether you raise the funds from equity or you raise the funds from debt or you raise the funds from preference, will your products sale be affected? Tell me, you really think that by selecting equity instead of debentures, your sales will be affected? Huh? Think as a consumer, guys. Think as a consumer. Basic thing. You have to buy a toothpaste. You go to the shop and ask him which is the best toothpaste. He tells you, sir, this is the Ayurvedic toothpaste. Okay. It has neem, it has tulsi. Okay. Some have salt, some have pepper. Put some oil. Okay. Make a sabji out of it and eat or what. Okay. But what he will explain you, he will explain the quality of the product. You say, wait, I'm not interested in the quality of the product. Tell me which company is earning the best EPS for the shareholder. I'll buy that company's toothpaste. I'll ask him, you understand what you are talking about, the quality of the toothpaste. Talk about indifference point. Talk about capital structure. Quality is not important while buying. Capital structure of the company. Is it a stand that we take in the shop when we stand over there? Hell with the capital structure. As a consumer, what we would say, give me quality product at a good price. Give me quality product at a good price. I'm not affected by the capital structure. So guys, whichever way you arrange your money, either by equity or by equity debt or by equity preference, tell me, sales will be affected? No. Variable cost would be affected? No. Contribution would be affected? No. Will the operating fixed cost be affected? Operating fixed costs like rent, salaries, will anything of that would be affected? No. That's why the comparison starts from where? From EBIT. Yeah. After EBIT, what is the next point? Interest. Tell me, will EPS be affected by interest? Yes. By capital structure? Yes. See, in the capital structure, if there is a debt, interest would be there. And your earning before tax will reduce. But if in the capital structure, interest is not there, then what will happen? Interest would be zero. Means, can I say that after EBIT, capital structure will make an impact? Yes. Can capital structure affect sales, variable cost, contribution, and operating fixed cost? Answer is no. Now, are you very clear? Why are we starting from EBIT? Why are we saying this? That it is that point of indifference. What is indifference point? It is that point at which EBIT of both plans is such that EPS is constant. It is that level of EBIT at which what EPS is same. I hope I'm very clear that why I'm not starting from sales. Indifference point definition, it is that level of EBIT at which what EPS of both the plants is same. Very clear? Up until EBIT, there is no impact. Yes. So I hope this reason is very clear, right? I'll remove these words. You should not have these words. One. Okay. Just explanation. Why start from EBIT and not from sales? Okay. That's what you should write in your book. Okay. Fine. So EPS calculation everybody knows. Pi upon number of equity shares. Should I be? I'm confident. I'm overconfident. Overconfident, Satya. This is overconfidence that I should I say that you know this. How to calculate EPS? You guys remember na formula? Did I show you? Some people are shifting their batches. So I don't know, but I have prepared that sheet, ratios and plans. So Meshwina, some people from afternoon batch are here. I can see them. And otherwise, in the evening batch, I have shown. I think in the morning batch, it just remained. I have not yet shown. Let me take a break from here. Not a break in the class. Give me 2 minutes. I'll share that sheet with you guys. So you can have all the ratios at one place. Is everybody in place? First of all, are you there, guys? Give me a moment. Hmm. All the ratios at one place, guys. All the ratios at one place. Um, I've kept it this way so that you can see in detail, right? If you are on computer, you know what you have to do. Don't take a photograph. First you do like this. Okay. Then you have an option to lift your whole PC and do it like this also. Great. Very good, Someshwar. Super. Uh, if you have a laptop or a PC, strongly recommend do print screen. You know now how to. Whom am I teaching? It's technical expert people sitting in front of me. Do press print screen. Open a Word file. Copy over there. So it will remain all clear, right? If the screenshot is not clear, print screen. Yes, yes. Yeah. If the screenshot is pretty easy, sir, copy, paste, and rotate. Okay. If you are on that mobile and if it is not very clear, you tell me, I'll show it in two parts. It's clear. Okay. What do you want me to send, Ray? This file you want? It's copyrighted, belongs to me. I'll give you GPay number, 100 rupees. Taken na? Screenshot is taken, right? Visible na? Screenshot is visible na? Okay, okay, fine. Then let's get back to our discussion. Sure, sure. Pay me royalty when we meet. I'll, let's hope, let's pray that that thing happen as early as possible and the whole world gets out of this pandemic as soon as possible. Right? Thank you, Priya. Somebody recognize the efforts. Okay, guys, let's go ahead. Yes, Laksha, thank you, dear. So let's get ahead, get back over here. Okay. So I was talking about this EPS and PERS. Okay, so for the reason I just showed you quickly the ratios, correct? I only prepare now. Somesh, who will prepare? Tell me. Huh? Someshwar, you don't. Handwriting is small, but actually you can find out some similarity in the handwriting. No, I told great. Oh, thank you, thank you, thank you. Huh. So now see the important point of discussion, guys. Important point of discussion. How we will write this PERS. So how the PERS is coming? PERS is coming like this: EBIT minus interest, EBT minus tax, EAT minus preference dividend. I want to put it in one line. Okay, I want to present it as a formula. See, that's why I've left a blank space. With discussion with you people, I'm going to write that. How from EBIT up to PERS, how can I bring it everything in one line? See, listen to me. How we can do it? Okay. I hope you will apply your things that you have learned yesterday, and it will be very easy for you. See how I'm going to write. I'm going to say EBIT minus I. Fine, guys. I means interest. I means what? Interest. Perfect. EBIT minus I. So I've already reached till EBT. Okay. Remember yesterday's discussion? Take a pre-tax value, multiply by 1 minus T, becomes a post-tax value. Guys, we did it. Wait. Naveen, wait. Don't do like that. Wait. Listen to me, guys. Listen to me. You remember yesterday's discussion about preference dividend? Huh? What did we discuss over there? NPBT minus tax is NPAT. Gradually, what we said? So take NPBT, multiply by 1 minus T. It becomes NPAT. Hello, people, you realize, no, we not, it's hardly 24 hours that we have met. Don't behave as if we have done it 2 decades back. 2 decades back, you did not exist. Most of you. Or even did you exist? You were just into the cradle. Dependent for food also on parents. So that will depend today also, sir. Great. So I'll multiply this by 1 minus T. EBIT minus I is what? EBT. EBIT minus I is what? EBT. EBT multiplied by 1 minus T. What it will become? Will it become EAT? Correct, na? Hello, people. Bouncer. Not within your range. Did you understand? Did you understand? Sure, na? And why you people are responding like this? Sir, it's indifference curve discussion going on. No? So we are showing you how to be indifferent. EBIT minus I is EBT. Everybody agrees? EBT multiplied by 1 minus T. What it will become? EAT. Correct, friends? Good. From that, what you subtract? So whatever you want to subtract, you subtract. Give us 3-4 minutes break. So that is our only important discussion. Minus preference dividend, guys, and we have reached till Paish. Agreeable to all of you now? Means one liner can be like this, right? EBIT minus I is EBT. Multiplied by 1 minus T is what? EAT. So from EAT, what to subtract? Just to subtract preference dividend and we are done. Clear? Hope you guys are writing, huh? Not sitting idle. Why so much juggling? I enjoy doing that. Hope you are written till here. Hello? No screenshot ceremony, huh? Right now. Done, people? I hope this part I have explained to you is clear, that why are we starting from EBIT, right? Why start from EBIT and not from sales? What are the wordings of indifference point? That level of EBIT at which EPS of two plants is same. So why are we not starting from sales? And we have our answer that capital structure does not affect sales, variable cost, contribution, and fixed operating cost. So if you are done, just write this: how indifference level helps to select a capital structure. Write this: discussed after. Write like this only. Write like this only. What is written in the bracket, Ray? That's the wordings of the this plan only. Wordings of the indifference point are that level of EBIT at which EPS of the two plants is same. So I'm just explaining that why not, why to start from EBIT and not from sales. The wordings of indifference point are what? That level of EBIT. So instead of EBIT, why are we not using sales? I think extra explanation is harmful to you. Hmm. Just write like this: how indifference level helps select a capital structure. Because see, we are talking about selecting a capital structure. What we are concluding, we are going to select that capital structure where EPS is maximum. And all the time we are talking about indifference level. It is that level at which EBIT is that level of EBIT at which what happens EPS is same. So we'll come to the conclusion part, because see, we are used to this, no, that we draw a conclusion and then we solve a sum. Right? We are normally like this, that we draw a conclusion. Okay, fine, this is how we will deal with it. Then we solve a sum. But I'm just saying that we will solve a sum and then give a final conclusion. Okay. So question number one that we will basically solve now. More than solving, it is about making you understand the importance of indifference point in selection of a capital structure. Okay, so question one I'm solving now, but more so it is to explain to you the importance of indifference point. Because see, right now we understand that it is that level of EBIT, sir, at which EPS of both the plans is same. But sir, we have to select a plan. No, how having a same EPS will help us to select a plan. We are only saying that same EPS means no indifference. So how this logic of indifference point helps us to select a plan, that is what we will learn. Should we leave page for indifference level theory? No, don't leave any page after this. Wherever you are, just start solving question number one with me. Wherever you are, miss, in the notebook. I know that you are at home. In the notebook, don't leave any space. Okay. Yeah. So I'm opening the question. Yeah. Let's come to question number one. Let's do one thing. Take 2-3 minutes break and then we'll continue, because I know people are like dying to take a break. Yeah. Because once we start the question, then we are not moving from our place. Okay. So take 2-3 minutes break, then we will continue. Okay, friends, chalo, let's start. Shall we? Yeah. Okay. So as I've already told you, main focus is to understand. We are solving, we'll be writing, obviously. But the main focus is what? To understand the concept of indifference point. Okay. Huh? So let's start. Let's read question number 1. Everything is working perfectly now. Audible, visible, screen sharing happening, everything going perfectly. Okay. And I don't mind if you eat, huh? No worries. Individually, it's not your birthright to eat in the lecture, but I'm okay. I understand. Young generation, hungry generation, no problem. Okay. So let's start with it. Adarsh Limited is considering methods to finance its investment proposal. Okay, so means investment proposal in place, and it is planning to do what? It is planning to finance it. Okay. What do you mean by methods to finance? Is how you raise the money. Okay. How much is required? 4 lakh rupees are required. See, that's what. Now, two alternative methods means what, guys? Two alternative methods means only one. There are two capital structures. Two alternative method means what? Two capital structures. That's what. Now, that's what the thing is. Now, we have to select the best capital structure. That's all about, no? Right now. And how the best capital structure comes? It is that best capital structure is that capital structure where what happens? Where EPS is what? Maximum. Where EPS is what? Maximum, right? Okay. So total to be raised is 4 lakh rupees. Okay. What are the options here? First option. This is option number 1. Okay. First capital structure. Issue 15% loan amounting to 2 lakh. So, and what about the balance? Issue 2,000 equity shares of 100. Got it? 2,000 equity shares of 100 means 2 lakh. That is the first plan. So 2 lakh from loan, 2 lakh from equity. That is the first plan. What is plan B? Issue 4,000 equity shares of 100. So it's like in plan B, it's all equity. You understand? Appropriate tax rate is 35%. Assuming operating profits, that means EBIT of what? 70,000, 80,000. Which financing proposal would you recommend and why? Simple answer to this. A very simple answer to this. What? We will solve income statement taking 70,000 as EBIT under situation A and B. And we'll select that plan where what EPS is maximum. Okay. Compute the indifference point of the two financial plans and also verify the same. Okay. Let's do one. Let's do one. First we'll compute the indifference point. Okay. I'll teach you how to compute the indifference point first. Okay. But before that, what we will do is we will write a capital structures, alternative capital structures for this. Let me open my question. Question number 1. Okay. So first thing first, as usual, we'll write over here solution to class of question 1. So the first thing I'll write is the capital structure. In some question, they would say financing plans. Okay. Right now, how many plans we have? 2 plans we have. Plan A, plan B, right? Okay. What is plan A? Plan A is going to have 15% loan for 2 lakh rupees. Plan B has no plan to take loan. Okay. Talking about equity capital, right? What is the plan? 2 lakh in equity over here. And plan B says we don't want to take a loan. We will arrange all the money with what? With equity capital only. Correct? So this way, your total capital, that's what is your need, na? Your total capital over here would be 4 lakh rupees. And anyway, 0 plus 4 lakh is again 4 lakh only. And that's what, no guys. We have to raise 4 lakh rupees. Option. Now you understood capital structure. That in option one we are mixing half loan, half equity. Option two, full equity. Somehow we will raise 4 lakh rupees. Either this way or that. Okay. Right below this, number of equity shares. You know what? We have to calculate EPS, so we'll need number of equity shares. So just always, whenever you make a capital structure in all the next questions, we are going to mention number of equity shares. So plan A has 2000 equity shares. Correct, friends? Plan A has 2000 equity shares. Plan B, how much? 4000, right? Agreeable to all of you? Okay, fine. So this, I have not solved anything. I just showed you the capital structure. Companies to select between these two plans. Companies like thinking now from where should I get all that 4 lakh rupees? Either go with plan A or go with what plan B. Everybody clear till here? Okay. So now first thing first, we are calculating indifference point. Calculation. I hope you people are writing. Huh? Calculation of indifference point. Guys, you are writing correct? Simultaneously. Oh, yeah. So what we say? At indifference point, what happens? EPS of plan A will be equal to EPS of plan B. Guys, you agree with this? Okay. Now, how to put it in the form of a formula? This is your answer. Why to make so much fuss about it? Is what I was asked. And now I will utilize it over here. EPS. How we will substitute? We will say EBIT minus I into 1 minus T minus PD. PD is for preference dividend upon number of equity shares of A. The left hand side is for A, na? The right hand side is for B. So here again I'll write EBIT minus I 1 minus T minus PD preference dividend upon number of equity shares of B. Guys, what is indifference point? Indifference point is a level of EBIT. Correct? Indifference point is what? Is a level of EBIT. At which what happens? EPS is equal to EPS. So EBIT is what we have to find. At what level this is going to happen is what we have to find. Okay. Plan 1. Does it have a loan? Say yes or no. Yes. So if you go for plan 1, will there be interest charged? Yes. How much? 15% of 2 lakh. Will that come to 30,000? Yes. So here in this substitution, I put 30,000 for interest. 1 minus T. Guys, what is the tax rate given in the question? 35%. So 1 minus 0.35. I hope preference capital is not there in both the plans. So this is nil. Okay. Preference dividend is nil. Here also it is nil. Right, friends? Hello? Did you understand this? I wish you people could pay a little more attention when I discuss with you. What are we doing? Calculating indifference point. Seriously, yaar. The chat box should be closed only. Don't talk to me. I'm explaining something, people are listening, imagining on their own. Right? Number of equity shares of Plan A. How many? 2000. Here again, EBIT. Okay. Tell me over here, is there any interest? No, it is nil. Done. Okay. 1 minus 0.35 upon how much? Number of shares are 4000 over here. Now we have to solve it further. Okay. Let's see. Can I cancel like this? 1 minus 0.35 and 1 minus 0.35 in full. Can I cancel like this? Yes or no? Yes, because it is having a multiplication sign in between. So the whole bracket's answer 0.65 can be cancelled. Is this clear to everyone? So, okay, I can also do this now once. I can say, okay, let me cancel this. It will make 2000 ones are 2000, 2000, twos are 4000. Correct? So let's cross multiply. Take 2 over here. 2 EBIT minus 30,000 is equal to EBIT. You want me to show one also over here? You write that. No need. So all mathematics, guys. 2 EBIT minus how much? 60,000 is equal to EBIT. Bring that EBIT this side. So what will happen? 2 EBIT minus EBIT is equal to how much? 60,000. So EBIT is equal to how much? 60,000. What we got? What we got? We got indifference level of EBIT. What we got? Indifference level of EBIT. So as per our understanding, if the EBIT is 60,000, both the plans would be same, right? So we have solved point 2, compute the indifference point and verify the same. Verification is yet to be done. But first what we have done, we have computed the indifference point. Those people who are messaging me that EBIT is given, please learn to pay more attention. Instead of just looking here and there. I told initially that we are calculating on indifference point, right? I know question gives you 70,000, 80,000 for a trial basis, but first what we have done indifference point. So according to our calculation, if EBIT is 60,000, both plans will have what? Both plans will have same EPS. So how this will happen? We will verify now. We'll verify. Okay, let's try and verify that. Okay. I'll just write over here. Does if EBIT is 60,000, then EPS of both plans would be what? Would be same. Okay, let's verify this. How will we verify this? You tell me. We make an income statement. Correct, now? We'll make an income statement starting from EBIT. We don't have data from salespeople and not required also. We'll make an income statement starting from what? EBIT. And calculate reach till EPS. Simple as that, right? Okay, let's do that. Achha, wait a minute. Don't So I'll show you. Other than that, in question number 1, sub question 1, they're asking you to take EBIT as 70 and 80 and find out which proposal to select. Okay, so how you will select? There also you will need to make an income statement. So see how I'm doing. I'm just putting all the possibilities. Wait. You don't conclude. Let me first draw the income statement. So you'll come to know so many columns to be made. Question is asking you to verify with 70 and 80. 60 is what we need. One more extra will be. So see, what I plan to do. We'll first verify whether we are correct or not. So here we will take EBIT as 60,000. What is the 60,000? Indifference point we got 60,000. So we'll verify that. Other than that, question is asking what if EBIT is 70,000? What if EBIT is 80,000? Guys, to explain you the concept of indifference point, I'm taking one more EBIT. You try and understand these both places. Listen. These both places, the expected EBIT is what? The expected EBIT is higher than indifference point. You understand? Our indifference point came to 60,000. And question is asking us to take 70 and 80. So in both cases, our expected EBIT, 70 and 80, is higher than indifference point. So let's take one situation where it is lower than indifference point. That's why one extra column. So here we are taking EBIT 50,000, going below the indifference point. And then in each EBIT, we'll have two capital structures, right? So here I would say for capital structure AB, correct? A, B, A, B, A, and B. Ready with the set? Ready with all these possibilities? Okay, so first we will check whether our indifference point idea is correct or not, because this is the point. No, suppose here itself it doesn't match, so we can say, okay, this concept is wrong. Chapter cancel. Write a letter to ICA. Nothing like that happens, but we will verify what we got. Okay, so I'm starting with the income statement. Yeah, this is the income statement. Okay. So from where we will start? Tell me. Start from sales or start from EBIT? EBIT. Everybody understands that, right? So what is this first? 60,000 is a possibility that we are considering. What if 60,000 is EBIT? less what? Interest. Right now you are at a EBIT level. So after that, directly interest would be subtracted. Guys, we've already done the capital structure. Understand that. We've already done the capital structure. We know that interest is there in the first plan, interest is not there in the second plan. Correct? So how much interest in the first plan? Even that we know. It's going to be 30,000. So just like writing the things again. 30,000 over here, nil over here, correct? So earning before tax, 30,000 over here, 60,000 over here. Okay. Less tax. Tax at the rate of what percent? 35%. So 30,000 into 35%, 10,500. I'll do minus equal to, I'll get the next figure, 19,500. Okay. So this is my earnings after tax. Right, friends? Now, less what? Preference dividend, but we know, sir, preference dividend is not there. So this itself becomes what? Our PAESH. 19,005. Yeah, let's complete this side. 60,000 into 35%. 21,000 minus equal to 39,000. This is nil, so this is 39,000. Okay, so now what? We will calculate EPS. For EPS, what is the formula? EPS is PAESH upon number of equity shares, correct? So tell me, PAESH is 19,500, true. But what are the number of equity shares in Plan A? I hope you remember your capital structure. Number of equity shares in Plan A are 2,000, in Plan B are 4,000. So take this, divide this by 2,000. Here it is 39,000. Divided by 4,000 and check your answer. This comes 9.75. Okay. This also comes 9.75. This is EPS dash rupees per share. What say, guys? Did you understand? Confirm. Concept is correct. That if the firm earns how much? 60,000 EBIT. EPS of both plants is going to be what? Same. Now you confirm this. Okay. So now we go ahead. I hope you have understood this idea now. Okay. Now we'll go ahead and check what happens if EBIT is 70. Now that we know, okay, 60,000 is the level at which EPS is same. Now we will check with the level of 70,000 and we'll check with the level of 80,000 and also 50,000 that what happens to the EPS. Okay. So I assume that first part is clear. Indifference point is proved. Okay. Fine. So let's try with this. So now let us take 70,000 as a expected EBIT. Yes, interest would be same, sir. 30,000 nil. Okay, so this would be 40,000. This would be same, sir. 70,000. Okay, let's calculate tax now. 40,000 into 35% is 14,000. Minus equal to, I get 26,000. Preference dividend is nil. This is 26,000. So EPS would be 26,000 divided by 2,000. That came to 13 rupees per share. Let's come to this side. 70,000 into 35% is 24,500 minus equal to is 45,500. This is nil, so you're left with 45,500. So 45,500 divided by how much? 4,000 divided by 4,000 number of shares. So I got it 11.375. Oh, that means we are not indifferent now. Guys, tell me if EBIT is 70,000, huh? You can signal me like this. If EBIT is 70,000, select plan 1 or select plan 2. Plan 1, why? Higher EPS? Everybody understood this? Sure? Got it? Now you've understood what we are doing. We're just doing trial error, sort of. Right? Let's try with 80,000 also. Okay. Suppose it is 80,000. Still, this will be same only. Okay, 50,000 to 35%. 17,500. We left with 32,500. So 32,500 divided by 2,000, guys, 2,000. 16.25. Okay, let's calculate this side. You know what happens? Why am I completing one? Because it becomes easy on calculator. Huh? You can go on like doing complete one side, then come to the other side. 35%. 28,000. 28,000 minus this is 52,000. So take 52,000 now, but divided by how many shares? 4,000. So divided by 4,000, you get 13 rupees. Guys, once again, my question. Plan A or plan B? Plan A, sure. EPS is visibly higher, right? Okay. Let's come to EBIT of 50,000. Now let's see, in both cases we have selected plan A. Let's see if the expected EBIT goes below indifference point, what happens? Guys, you know, this is not asking the question. 50,000 column, this is extra to make you explain better. Okay. So let's take 50,000 and then let's see what happens. Interest will remain same now. So 20,000, 50,000. Okay. 20,000 into 35% is 7,000. Okay. So 13,000 divided by 2,000. 6.5. Okay. Let's see the other side. Oh, change, guys, change. Correct, huh? Some changes happened, no? This side is better now. Number got Hope you understand this long procedure. You can see some rule coming out of this. I told you, no? Here, after how to select a capital structure with the help of indifference level. We'll discuss after studying the practical solution of class work 1. And now I can see a rule can come out. What will be that rule? See, I'll show you. Conclusion. Okay. Rules of selection of financial plans. Rules of selection of financial plans based on indifference point. See, guys, the first situation that we faced, okay, where expected EBIT greater than indifference point. Did you realize this? EBIT of, for example, if you want me to write, I will write expected EBIT of 70,000, expected EBIT of 80,000. They were both higher than the 60,000 indifference point. Yes or no? In both cases, we have selected which plan? We selected plan A only. What is the speciality of plan A? So I'll say expected EBIT greater than difference point. Then, sorry, then select levered plan. That is a plan with debt. Realize this? I always tell you, see, you always are people are like of this opinion that sir, having more equity is good because we don't have to pay them anything. And I've always told you that respect debt equity ratio. Now you see, indifference point is 60,000. Once you cross that level, favorable leverage is playing role, guys. Favorable leverage is playing role. You remember favorable leverage learned in the last topic. To the debt, interest payment is fixed, 30,000. I earn more, still I pay 30,000 only. The balance benefit goes in whose pockets? Equity shareholders' pockets. Segmental classification we had discussed. Expected EBIT is crossing the indifference point. Indifference point is 60,000. Expected EBIT is above that, 70,000, 80,000. Whatever expected EBIT increase, interest doesn't increase. So the benefit goes in whose pockets? The benefit goes in equity shareholders' pockets. So in both the plans, what you notice, in both cases, what you notice, the plan with the debt is a good idea. That is called as a levered plan. Did you understand this? Right? Okay. So expected EBIT greater than indifference point. So what we'll say? The best thing to do is what? Select a plan with a debt, that is select a levered plan. Okay. The example that we took on our own. Expected EBIT is less than indifference point. Okay. Example. What we did, we took the expected EBI to be 50K, and the difference point doesn't change. Now that remains same 60K. Now what happened is you breached that level of 60,000. 60,000 level is breached, and your EBIT is going below that. You know what happened? Suddenly, till yesterday, when you're having 70,000, 80,000 EBIT, and you drop down to 50,000, your bullion difference point, that payment of interest has become a burden. Unfavorable leverage. By keeping the debt, equity shareholders are ending up paying from their pockets. The leverage has become unfavorable. So what do you notice? What you notice in the income statement? What did you notice? Now, which plan is better, plan A or plan B? Plan B is better. Why? Because if you go with debt, then it is becoming unfavorable leverage. Means returns are less and the interest cost is high. Did you understand? You remember capital structure topic? You remember the topic earlier? Capital structures going on, sir. The earlier topic, leverages. There we had written a note whether this plan is favorable, having a favorable leverage or not. So that time I explained to you that favorable leverage or unfavorable leverage depends upon the returns. So probably what is happening with this expected EBIT of 50,000? It will be a favorable leverage or unfavorable leverage? Favorable leverage or unfavorable leverage? Unfavorable leverage. If you take loan, you will lose money from your pockets. Are you getting me? So what do I do now? You tell me. What is our rule? If expected EBIT, if expected EBIT is lower than indifference point, select which plan, levered or unlevered. Unlevered. I hope you got this point now. How to conclude, sir? You are teaching something that indifference point. We want to know how to select the plan. You're teaching indifference point. See now how indifference point helps you to select. So let's conclude. Then select unlevered plan. That is a plan without debt. Okay, sir. One more situation, please, sir. Should have three situations. Yeah, we will have three situations. Expected EBIT is equal to indifference point. This is such a funny situation, guys. Expected EBIT is also 60,000 and indifference point is also 60,000. What do you say? Which plan will you select? Sir, any plan. That is a point of indifference point. Sir, any plan. EPS is as such one. Same in both the cases. 100% agreeable to you all guys, right? So what is the final verdict? Then select any plan since EPS of both plans will be same. I hope everybody has understood. Okay, so see, this helps you to understand what? This helps you to understand indifference point. I told you, we will solve a question instead of creating all imaginary possibilities. You're solving a question. Tell me, friends, seriously, absolutely clear with this idea, with all these possibilities, right? Okay, thank you so much. One more concept. One more concept is there, right? If you go through the question also asks you to calculate financial break-even point. Okay. So we need to first understand that concept and what exactly is financial break-even point. Okay. So 21 people. I'm still not done with this. Anybody taking screenshots? Someshwar, you have to take a screenshot, dear. Array, I'm not yet done with this. I'm going to continue with the financial break-even point now in this. This page is over, obviously. I will not be able to write over here. On the next page, I'm still to talk about here. I'm going to talk about financial break-even point. Okay. Oops, let's do that. So let's talk about the next point, what it is. Financial break-even point. Okay. Anybody has to ask anything? For a moment, I will pause. Chat box is open. Now I explain the concept. I'm going to put the chat box off. That's a chatter that irritates. People live in their own world. See, you people keep, many of you keep a status on your Insta and FB accounts, no, my life, my rules. Like that, this is my lecture. It goes with my assumptions. I mean to say, see, I don't rule anyone, but to understand this concept, you have to think like this concept. Right now, you have done so much of this in economics. Alfred Marshall, you have studied, Keynes, you have studied, Hicks, you have studied, Pigou, you study. So many people you study. Everybody gives their assumption. If you accept their assumptions, then you understand now. Unlevered plan means there is no debt. As simple as that. Why to select that? Because unlevered plan, we can see that EPS is what? Maximum. Okay, so basic idea is this only, that you select a plan based on the EPS. But we can draw a shortcut. Okay, fine. A plan without debt will be preferred if what? If expected EBIT is lesser than difference point. Okay. Buy is off now. Buy means chat box goes off. Your chatter is between now. The next thing is I put you in the waiting room. So you can do that. Yeah, I can do that. Now let us understand the next concept. What is that? Financial break-even point. And then as usual, people like, we know break-even points. Break-even points. No profit, no loss. No profit, no loss. No profit, no loss. That's always a thing. Like you remember, guys, in the last topic also, we did talk about break-even. No, remember, no. Okay. We said that break-even means what? No profit, no loss. Means what? Fixed cost and variable cost get covered. Remember that 20,000 units break-even level, 1 lakh fixed cost missing. We found out, and then we found out operating leverage for a level of 25,000 and level of 30,000 units. Right? So there is a break-even point where all fixed and variable costs get covered. Now we are talking about financial break-even point. So financial break-even point will be what? After clearing all financial logic, financial responsibilities, nothing would be left for equity shareholders. Equity shareholders would be like no profit, no loss. When equity shareholders are in no profit, no loss, EPS would be zero. When financial break-even point, we're not talking break-even point, we're talking about financial break-even point. So who are the ultimate owners of the business? The ultimate owners of the business are equity shareholders. True that, right? So where they would say, okay, we have reached equilibrium or we have reached break-even. They would say, okay, we invested money in this business, but after paying all financial obligations, our earnings are zero. No profit, no loss. That's what your interpretation. Na? Break-even point, what is your interpretation? No profit, no loss. No? So simple as that. Okay, as an equity shareholder, what would I say? I started with this business. I invested my money. I paid to everyone. I paid all operating expenses. I paid all cost of goods sold. I was left with EBIT. I paid interest. I paid preference dividend. I paid government tax also. And at the end, nothing is left for me. My POISH becomes zero. I'm not at loss, but I'm not at profit also. My POISH is zero, so my EPS is zero. Got it? So, what will be financial break-even point? See, guys, we are not talking about debenture holder and preference shareholders. Right? We are not talking about debenture holders and preference shareholders. Why? Hey, people, their returns are fixed. No, they are never interested in knowing the final result. They know that I'm going to get this much returns. So equity shareholders, it will be always equity shareholders who will be concerned about this financial break-even point. Financial break-even will be calculated for equity shareholders. So they would say, okay, I reached that level of POISH and that level of EPS that after paying everybody, I'm not left with anything. Okay, nothing has gone out from my pockets, but I'm not left with anything. Did you understand this? Okay, fine. So we will define it. It is a no profit, no loss situation for whom? For, yes, equity shareholder. Correct. Financial break-even point is definitely a no profit, no loss situation only, but for whom? For equity shareholder. That is after paying all expenses or So what you say, that is after paying all equity shareholder gets nothing. That is Payesh is equal to nil. Therefore, EPS is equal to nil. Read the statement carefully. It is a no profit, low loss situation for equity shareholder. That is after paying all. You pay interest, you pay tax. I have to put tax in between, no? Between interest and preference dividend. Because after paying interest, EBT is left. Then we have to pay tax also. So after paying interest, tax, and preference dividend, equity shareholder gets nothing. That is Payesh is nil. Therefore, what? EPS is nil. Okay. So to conclude, so this was a to conclude, FBEP, financial break-even point, is that level of EBIT at which what? EPS is zero. Okay. For a moment, I open the chat box. Tell me, have you understood? If you're concerned, then you can reply, because all people don't do like this. Some people are like, okay, thank you, friends. Clear, huh? Okay, good. Yes, fine. Okay, Lakshmi. So, bye bye. Bye bye, chat box, bye bye. This is what is financial breaking point. Guys, I hope you are writing along with me. You're not leaving anything for screenshot today, right? So if you're done till here, then I will proceed further. Written everything? Okay. Let's then go ahead. So how we will calculate it, sir, actually? Simple. What we said just now at financial break-even point, what we said, EPS is nil. Correct, my friends? How we write EPS? Forgot. Payesh upon number of equity shares is nil. Any quick explanation for Payesh? What you did while doing indifference point? EBIT minus I multiplied by 1 minus T minus PD. So how this will be further manipulated? People, this part I have just used an indifference point. Payesh, EBIT minus I is EBT. EBT multiplied by 1 minus tax is EAT minus preference dividend. We will reach Payesh. Okay, fine. Little of mathematical modifications. EBIT minus I 1 minus T minus PD is equal to nil. So the number of equity shares we forgot to write. What say, guys? Try on your calculator now. Number of equity shares are 4,000. Nil means zero. So that's what. So it will come this side, it will multiply. So multiply 4,000 into zero. Zero. That much maths we understand. Good. Okay. Therefore, EBIT minus I 1 minus T is equal to PD minus preference dividend. Came this side, it became plus PD. Therefore, EBIT minus I is equal to PD upon 1 minus T. 1 minus T was multiplied on left hand side. It became to right hand side. It got divided. Okay. Therefore, EBIT is equal to minus I comes this side plus I plus PD upon 1 minus T. And this is 1 minus T only to the denominator of PD. Don't pull it for interest, right? So this is your final interpretation. Sir, what is this EBIT, sir? What we started with? We started with financial break-even point now. What is financial break-even point? It is that level of EBIT at which EPS is 0. So guys, this EBIT that you've got now, this is nothing but your indifferent. This is nothing but your financial break-even point. This EBIT itself is our financial break-even point. Okay, let's do one thing. We have two plans, plan A, plan B. Let's calculate. So let's calculate FBEP for plan A. So I'll say therefore financial break-even point, that is what EBIT is, interest plus preference dividend divided by 1 minus T. But guys, go through your notebook. Plan A doesn't have preference dividend. So this part is nil. I think plan A has interest, no? That is how much? 30,000. So what is the financial break-even point of plan A? It is 30,000. Means what? That is up to EBIT of 30,000. What I will say, EPS will be nil. Okay. Let's do it for plan 2, plan B. FBEP for plan B. Again, the formula will same. FBP, that is the level of EBIT. Is equal to interest plus PD upon 1 minus T. This is nil. Sir, interest is also nil. Wonderful. Nil plus nil. 2 nil. 2 nil. 0. Correct. Very good, Someshwar. Read. This will be nil. Simple. Means here the financial break-even point is 0. So what I would say, if EBIT exceeds nil, EPS would be positive. So what, guys, what we conclude from this? Higher FBEP is equal to higher risk. What you can say, in plan A, I will have to wait till my EBIT crosses 30,000. No, not understood. We'll make a quick income statement. See, let's make a simple income statement. Starting with EBIT 30,000. Okay, so what will happen in plan A? If EBIT is 30,000, my interest itself is 30,000. So gone. EBT nil. Correct. So tax nil. Correct. Then EAT, OIH, EPS, everything would be nil. Understand? So if I take a loan, no guys, if I take a loan on which I have to pay 30,000 rupees as interest, I need to understand Unless I cross a EBIT of 30,000, nothing is going to come to my pockets. Understood? See, suppose this EBIT now becomes 40,000. Then we know even this would be same. But sir, EBIT would be there, no, sir, 10,000. Yes. Tax is 35%, sir. So gone 3,500. So I'll have a Payesh of 7,500. Correct? Then it will be divided upon the number of shares. So there will be definitely some EPS, which will be positive. Right? So here there will be some EPS. Did you understand what I said? So here, if I've taken a loan, no, what will happen, guys? I'll have to wait till how much? To my EBIT to cross how much? 30,000. Then some money will come in my pockets. Right? 6,500. Sorry. Okay. Now let's talk about plan B. Let's talk about plan B. What we got in plan B? We got simply financial break-even point at 0. Correct? So suppose I say I'll solve here on. Okay. Suppose I'm in plan B. EBIT nil. Interest nil. Correct? EBT nil. Tax also nil. Right? EAT nil. Wonderful, sir. Payesh nil. EPS nil. Okay. Let's say this person makes a first sale and he gets a EBIT of 10,000. Suddenly everything will get activated. But this is nil only. So this is 10,000. He will pay 3,500 from his pockets. He'll be left with 6,500. Payesh would be 6,500. Plan B, guys, plan B. What are the number of shares in plan B? 4,000. If I'm not wrong, it's 4,000. Right, friends? Definitely it is 4,000. So the EPS would be how much? 6,500 divided amongst 4,000 shares. Start making 1.625 rupees. Getting? Here, you will have to wait for the EPS to cross how much? 40,000. Sorry, EBIT to cross 40,000. Sorry, EBIT to cross how much? 30,000. We got financial break-even point is what? 30,000. Now you tell me. Higher financial break-even point means higher risk. Okay. So shall we not take, did I say that? It depends from person to person. Because we know if we go for a levered plan, initially risk would be there. But if our EBIT is zooming up 70,000, 80,000, 90,000, then what happens? Interest component remains constant. Rest of the money goes in the pockets of whom? Equity shareholders. Right? So please don't come to any conclusion. Just understand this rule that higher FBP is what? Higher risk. That's it. I hope this explanation, these two income statements that we make, they add to your understanding. Right? That in first plan, here, right? When we talk about plan B. Okay, this is what I've talked about plan A because this is what I've discussed plan B directly over here. This is plan A over here, guys. Plan A I've discussed over here. Okay. So what is the final conclusion? Higher FBP is what? Higher risk. Okay, I'm opening the chat box. You have any concern, you can raise it related to this. Let's write the solutions, guys. Solution to part 1. If EBIT 70,000, select plan A. If EBIT 80,000, select plan B. Okay. Point number 2, compute the indifference point that we have already done, right? So I hope that much you understand. This is computation of indifference point. So this itself is your answer for point 2. Okay, where you conclude. This is EBIT. Okay. Point number 3. Calculate FBEP. So this is point number 3. Let's calculate FBEP when I say this is your answer for point number 3. Okay. So the explanation part you can remove and you can write FBEP is 30,000. FBEP is nil. Right? What did I write? Achha, sorry. Plan A. So sorry. Plan A, both cases plan A. Okay. This is already solved. Right. Third is also solved above. Yeah, 80. That was just my writing mistake. Yeah, just last thing is what we will do screenshots and then we will stop. Now Someshwar will put 58%. Someshwar. If question asks you to verify, then you will have to verify and prepare an income statement. Otherwise, no need. Right, 58%. Someshwar, I know which 58% means zoom to the maximum height. You keep noting all those things only, huh? Comedy. Yeah, if you are done, absolutely no. The lecture is done, guys. Lecture is done. So it's like you have to note something. You have to take the screenshots. Be there. You have to ask anything related to the topic. Be there. Otherwise, bye bye. Enjoy your break. Bye bye bye. That's it, guys. We are done. Anything to be asked? Anyone? Bye bye bye. Those who are done can leave. What do you want, Someshwar? Bye bye bye. Sir, once again, show the ratio at glance. Yes, bye over here. You have a lecture at 10 o'clock, no, guys? Go, take your break, go. If you have doubt, then yeah, Kunal, thank you. Kunal, like, thank you, sir. You want ratios at glance? Thank you, thank you. So, Meshwar, taking this screenshot of this part, scroll. Hmm. Done? Okay. Yeah, bye, bye, bye. Go, take your break. Would you show FBAP? Who's that? Priya. Priya is there in the meeting. She has left. She's there. Okay. Hmm. See, I've kept the whole of the discussion like this. Starting over here, financial break-even point. It is a profit of no loss. It is a situation of what? No profit, no loss. Right? For whom? For equity shareholders. Means what? After paying all interest, tax, everything, nothing is left in their hand. So what we say to conclude, it is that level of EBIT at which EPS is zero, and then we calculate like this. Okay, fine. How to calculate? Then this is a formula. At FBEP, EPS is nil. How you arrive at EPS? PAESH upon number of equity shareholders. You substitute for how to calculate PAESH. So reach an EBIT like this. This EBIT itself is what? It is our financial break-even point. Because once you have the formula, then for any particular plan, just go and calculate it. Suppose you want to calculate for plan A. You know that in plan A, we have an interest of how much? 30,000. So interest, we put 30,000. Preference dividend is nil. So for plan A, our FBEP financial break-even point is coming 30,000. What does it mean? Up to EBIT of 30,000, EPS would be nil. So we solved a statement based on this here. For plan A, we did it here. Okay, we take EBIT, assume EBIT is 30, interest is paid 30, EBT nil, tax nil, EPS nil. Nothing is earned to them. The moment, suppose this becomes 40,000, then what happens? Okay, 30,000 interest will remain fixed. Whatever extra is there, a proportionate amount will go for tax, but the balance will come to the pockets of shareholders. So suppose I want to calculate EPS over here. EPS would be how much? 6,500 are the PERS. Number of shares are 2,000. So 6,500 divided by 2,000 will make it 3.25. So something comes to their pockets. Is Priya there or I'm talking to anyone? Anybody listening to me? People who asked out. Bye bye. Okay, chalo, bye friends. Let's close the topic. Bye.